also. I want to kind of jump into, there's a lot of things happening with our market right now. And so, we are in the midst of a market shift, and we're going to go over a lot of the data with you on that kind of stuff today. But you got to understand that this is the time for us to be ramping up the engagement that we're doing with our clients. And we have the opportunity to either grow and gain credibility, or we have the opportunity to lose credibility.
Well, I mean, with everything that's going on in the market, not only that with the NAR and the pickle with federal Department of Justice, we really have to ramp up educating a client what it means and not having to listen to what's on the internet, because
any of the news is going to be bad about real estate. I mean, just you look at it and especially like last week when the Fed raised the funds rate. And so, there's this huge knee-jerk reaction that's not really indicative of what's really going on in the market, but the news picked up on it big time kind of thing. So education is such a big deal. The other thing that's going to go on is we have to be ready for this shift. And so it's time to relook at our pricing. We are not seeing property declines. We aren't.
No, but the property is holding steady.
It is holding, but the deal is that the days of like, I'm just going to throw it out there, those properties are going to sit. That's what we're seeing right now. It has to be priced to move. If it's not priced to move, the consumers are just going to let it sit.
And the reason being, with interest rate, they can't afford a monthly payment anymore. So what a client used to look at $400,000 back in December is now only eligible for $325,000, a little less.
So, as we went over in our sales meeting last month, and I'll share some data from that, we have to be very realistic about what's going on with our market. Yes, there is a lot of pressure from interest rates on there, no doubt, but we still have such huge deficit of supply. It's not even funny. So we are seeing supply tick up, which is actually, as weird as it sounds, a good news, because that's what we've been wanting for forever, is good news. I mean, is the supply to increase kind of thing.
And unfortunately, with the uptick of interest, is not helping a lot of home buyer right now. And that's one of the things that it's, really kind of put a market in a what I call wonky position right now.
Yeah, it is. Well, so on Wednesday, the Fed raised the federal funds rate 75 basis points, which is really, really huge. It hasn't been since like 1994
40 years.
That they have raised rates that much kind of thing. And so, but we have to understand also that our mortgage rates aren't dependent on the federal funds rate. It is affected, on the side kind of thing. But realistically, it doesn't truly affect that. Now, the Fed does have some power over that, because they also buy, MBS, mortgage-backed securities, and they're tapering off, and they're not buying those, and they're actually selling those off, which is helping to keep the 10-year Treasury prices a little bit elevated right now, which is what we're seeing there. And plus our lenders have had a bit of a knee-jerk reaction, and I'll share some information with you on that. But after they raised the Fed's fund rate, Powell came on. He talked about housing, and there was a couple of points about housing that they're really looking at. And so, they're aware that the rates have moved up a lot. And do they think that it's going to affect residential investment? They don't think so, but they're not really sure. Do they think that property values are going to drop? No, but they don't really know. But they don't think so. He actually said, I think prices will probably still go up for a while.
I don't see it, just because I'm not feeling that in our market. And matter of fact, I have seen some offers right now that are not at sale price, and they're a little decline from the list price.
Well, and for those offers those listings that are overpriced, we are going to start seeing offers come in under asking in here. But one of the big things that Powell said at that meeting is, we need to get a place where supply and demand are back together, kind of thing. Inflation is low and mortgage rates are low again. So believe me, the Fed wants to get the interest rates back down again. The fact that it jumped up so far, I wanted to kind of share with you if I can actually find my share screen. There we go.
And what it does.
So like this is what happened with when the Fed hikes their interest rates. You can see that like back in 2008 during the Great Recession, it was way, way higher. It was up over, it was 5.5. So we're at 1.75 now, which is really historically still pretty crazy low at this point. The markets just had a big knee-jerk reaction. Actually, the market's reaction was much more based on inflation than it was based on the Fed's interest rates. Now, that being said, we did see the interest rates jump up. And so interest rates this past week went to a 5.78. So, you know, did they move up? They did. But that movement up was largely from a knee-jerk reaction and not, and like, I want to show you something in just a second. Now, the weird thing about all this is even with rising interest rates, guess what happened to mortgage applications last week? Mortgage applications went up for the first time in 5 weeks. Okay. So it shows that there is still demand in our market. Folks still want to buy homes. We still have the largest millennial generation.
Well, I think a lot of people, when they, after December, they kind of sit still and thought, hey, you know, interest rates will come down again. And as they watch for the last few months, as it decline and continue to decline, they're like, oh no, we need to go ahead and lock down our interest rate and start really looking at this point. So, you know, and they're, all they hear is that it's going back up. And so therefore they're trying to catch it before it really hike up.
Well, you know, that's a big piece of it right there. But, you know, the thing is that there is still a lot of demand in our marketplace. We can't let ourselves turn into this negative Nelly, listen to the news and think that, man, nobody's buying right now. Because we saw that so much of that happen in 2008 when agents talked themselves out of business, wouldn't do the normal things that they would do, reaching out, following up with clients, that kind of stuff, and just be like, well, the market stinks, and then just kind of like throw your hands up and then you go eat bonbons all day.
And honestly, Alan came in 2007 and started on REM.
Yeah, we pivoted, and
we pivoted with REM BPOs, and that's was a big chunk of our business.
So, you know, I wanted to share this here with you. So even though that they raised it to 75 basis points kind of thing, our mortgage rates are based on the 10-year Treasury. And as soon as they raise the federal funds rate, guess what happened to the 10-year Treasury? A big fat nothing, zero, no movement of the 10-year Treasury after they raised after they raised the federal funds rate.
Right.
And so, you know, we shared this at the sales meeting, but you can see that for 50 years, the 30-year mortgage rate has been based on the 10-year Treasury, and the average spread is 1.7. That 1.7% is the average difference between the 10-year Treasury and the 30-year mortgage rate. Well, this is where we're at right now. So we have a normal, actually it's higher now than that because the spread has gone even more. This was right before, because I shared this at the sales meeting last week. As of this week, the spread is about 2.4 to 2.5 right now. So there is a lot of, I want to say, you know, knee-jerk reaction, lenders hedging their bets, that kind of stuff going on with mortgage rates right now. We do see mortgage rates leveling off, going back down 5.5, 5.25, somewhere in that range. We just have to kind of keep our heads screwed on and not listen to too much of the negative news. It doesn't really know that's only looking for headlines and not really what's happening in our marketplace.
Entertainment.
Well, it is. Yeah, you're exactly right. And so you can see that even though our mortgage amounts have gone up, our loan size has not. Okay. And so this is a big shift that we as realtors have to understand, is that for, you know, like, okay, my interest rates are higher, my borrowing costs are higher, I can still only afford $2,200 a month or $1,800 a month.
Right.
And so what we're having to do is go back and change a list of what are the properties that we can really afford, what, you know, that kind of stuff. So, you know, for all your clients, you need to go out and help them reevaluate where they're at on their price. You need to be working with your lenders. You guys need to be talking together about what's going on. What is a true purchase price of what they can really afford in this marketplace? Because that's what we're seeing is people are shifting. They're shifting to homes that they can afford to own
on a monthly basis. So it's all about, it all comes down to monthly budget.
So Renfid just did a new analysis and said that even though all these prices gone up, home buyer budgets have stayed flat. That's a big deal for us to understand. Now, also one of the things that we just shared was that the average the average buyer's power dropped by $44,000. So if you could afford a $350,000 home in January, now you can afford a $306,000 home.
Right.
And so, that's just an average. That's kind of the average here in Georgia, that kind of stuff. But $44,000 is a pretty good kind of barometer benchmark for you to be able to use with your clients on. We have to be realistic about what the purchase price is going to be so that you can stay within your budget.
Absolutely.
We don't want to make our clients house poor, because you can see that right now, the monthly mortgage payments since January is up $820 a month.
That's huge, y'all.
That is a really big deal.
If you think about too, last year and the year before, we had some stipend from the government, the federal government. So, that's no longer here. And now you're looking at an increase of not just mortgage, but also food costs and fuel costs. So there's not a whole lot of disposable income.
Well, and the other thing that's going to be putting a lot of pressure on housing for us right now is if you look at, up until about the last couple of months, mortgage payments and rent payments have really been kind of running pretty neck and neck. But with the big jump in interest rates, now you can see that monthly mortgage payments are up 65%, whereas monthly rent payments are only up. When I say that, only up 17%, that's still an astronomical number. But we're losing, for the home sales side, is kind of losing the battle of, do I rent or do I buy? Over the last 2 months, we kind of shifted into an area where it's more economical, and a lot of times, and everything is local. Okay, that doesn't mean it's across the board, but just generally speaking, affordability is becoming our issue right now. So we're going to see where all the homes that are priced under 250, under 300, those are going to get a lot of activity. It's the ones that we're going to start seeing more and more pressure on price point and here.
400 and above. That's where I see some of the
less pressure.
Well, yeah. And also more time on the market when you price that.
Well, and so this is new data from the National Association of Realtors, and you can see the total active listings, the number of total listings that we've had. It was up 3 weeks ago. It was up 11%. Last week it was up. Week before 13%. Last week we're up almost 20%. And now the interesting thing is, if you look at median list price is still up there. Mm-hmm. And so don't think that that just because we're starting to see inventory rise, that means immediately pricing are going to drop. Now that will put some pressure on there, that's for sure. But we're not seeing that. You can see the same thing in this graph that we're, and the reason I want to show this is, okay, yes, inventory our active listings are increasing. But look where we're at versus, yes, this is the whole thing about the news, right? So yes, inventory is like 17% higher than it was last year, but last year was ridiculously stupid, and the year before that was stupider then. And so if you look at where we are back from 2019 and even 2020 on average listing counts, just nationwide, we used to have somewhere between 12 and 1,500 properties, 14,000 properties for sale.
We're looking at 500.
We're about 516,000 properties. So we're somewhere in the third
what we used to for our
pre-pandemic numbers. So yes, things are trending up on inventory, but you know what? It's kind of a good thing. Mm-hmm. And I know that sounds crazy, but that's kind of what we've been, we've been so long. It's been sellers hold all the power. Sellers, it's not fair. It's not fair. Well, now we're starting to see a shift. Now at the same time, this is the survey on the home purchase sentiment index on, is it a good time to buy versus is it a good time to sell? And you can see that a lot of our consumers say it's a bad time to buy. And so, that's not great for us right now, because a lot of Americans, especially right now, are extremely pessimistic about things. And, however, the good news here is that the housing market is set up to really start to gain some momentum, because finally we're going to have inventory. I mean, for the last couple of years, I've heard, especially buyer's agent, like there's no inventory. It's such a battle. We can't, there's no houses to show. They're gone immediately. Bum, 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 bum. And now we're starting to see inventory uptick. And now I'm hearing the sky is falling. Things are terrible. We can't do this. Da, 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 da. Like you can't, like this is what we really wanted to see happen. And honestly, this is exactly what the feds want to see happen too, is that they're putting pressure on the housing market because that's helping to cause some of the inflation issues. So, understand that this is still a very flexible situation where we're
housing market is not the only inflation issue right
now.
No,
it isn't the only one, but it is one of them. It
is a contributor.
Yeah.
Along with fuel prices and cost of goods sold and everything else.
Now, a lot of times we hear news and we just think that this is indicative of everything going on in the market. And so like if you kept up with real estate information, you'd see housing market correction intensifies layoffs. Redfin cuts their workforce by 8%. Compass cut their workforce by 10%. And there's, especially we're getting back to the whole news thing of, well, see, the market's going bad. The market can't hold it. The market's doing bad.
Sky's falling.
Allow me to kind of share with you a couple of things. So this is Compass's stock price for the last 5 years. Now, if I owned a company, let's say I own Compass, I would want to see the stock price moving in the positive direction. You can see that for the last, 2 years, the stock prices at Compass have gone down, down, down. Matter of fact, Compass hasn't made any money. So when you don't make money, what do you have to do?
Cut your layoff, your labor.
Yeah. How about Redfin? How's Redfin been doing? I mean, we've gone through some of the 2 best years we've had in real estate. What's Redfin's stock prices and profitability done? It's kind of gone down. So it's very, not just them. How about Redfin? Zillow. So here, here's Zillow and Redfin. Now we just showed you Redfin again, but this one here shows Zillow. So again, all these stock prices are down. But you can't say, gosh, the market's been bad for these 2 years. So the last couple of years, that's why they're, understand that it's a very convenient reason or excuse to be able to say, hey, these market corrections, that's the reason why we're doing these price reductions. But really, if you look at it, they're not making the money they need to make, and their stocks are based on their profitability and their earnings. So understand that there's the other side of this of
right.
Like just the straight market realities. If you lose money and you own a business, what do?
You cut your labor.
You cut your costs, right?
I mean, that's one of it. Marketing's the other.
Yeah. So don't read too much into who's hiring and firing and that kind of stuff. You just don't know. I mean, for the last 2 years, Compass has been just on a massive hiring spree because they've had a lot of VC money in.
Right. So, and sometimes, unfortunately, when a company in growth, when they don't watch their growth and their expense, they tend to overhire and also compensate folks at a much higher rate. Than they should. And sometimes, unless you dig into their financial, you don't know what the upper management is making. And that may be one of the cause.
All right. So Realtor.com just issued a updated forecast for 2022. As I think every single company and economist and the whole 9 yards was, hey, in January, we really thought this was what was going to happen. And guess what? Now we're in June and we were way off. And so this is their updated one. And we kind of wanted to share that with you as well as what we see happening in the market. And so, originally they looked at the sales price being up 2.9. Now they're looking at being up 6.6. That's on a yearly basis. So we really do see prices flattening out. Existing home sales, instead of being up 6.6, they're looking at down 6.7. We think that's pretty realistic. Actually, we think it's probably going to be closer to 9%. Is existing home for sale inventory? They thought it was going to be really flat. Now they're looking at inventory being up by 15%. But you can see that's still just a little tick of how much we're down about 2/3. So we still have a lot of inventory that we need to go. They thought interest rates was going to be about 3.5. Instead, they think they're going to level off at about 5.5. I think that's pretty close.
I think it's probably going to stay around 6. Because right now, when I talk to all my affiliate lenders, and they're telling me that 6% is the best they can do right now, and there are a lot of clients right now buying down rates as well.
So for our crystal ball says we're going to see number of transactions down about 10%. However, we're still going to keep seeing dollar sales increases in there. People still need and want houses. Inventory is going to increase, but it's going to be slowly. Shortages will still persist. Good price for homes are still going to move. Buyers are going to definitely need to rerun their numbers as they re-enter the market. Now, this one here, market's crazy. It's driving interest rate. I mean, it's driving just really crazy fluctuating interest rates, but they are going to be flattening to a slight increase. We said this last week before this, and it did exactly what we said. We're going to be seeing property values flatten for the year, and then affordability is going to continue to be a big issue for us. So that's what we see happening, and that's what we need to be really comfortable and confident about what's going on in our market.
And at the end of the day, it's about the monthly budget. Lender, in order to approve a client for the purchase of a home, their monthly budget had to stay within line. And so unfortunately, they were looking at homes that are $50,000, $75,000, $100,000 more what today's market that they're for based on the monthly budget.
Now, one good news is that the investor activity is down nationwide 17%, but here in Georgia or in the Atlanta area, investor activity is down 25%. So that has kind of scared them off a little bit right now. The market fluctuations has really driven down some investor activity, which is also helping us to get a little bit more inventory levels.
Well, and also, with investor, capital I, they're there to make money, and rightfully so. We need them.
Yep.
But at the same time, they're afraid that the housing is going to be, the rental rate is going to price out to where you can't get someone in there.
Yeah. Now, the home builder sentiment dropped to its lowest levels in 2 years this past month. At the same time, they have slowed construction down, which is really not a good thing. That's not what we wanted to see happen. So even though we may start seeing more inventory on the resales, it looks like there's been 6 consecutive monthly declines in the home builder sentiment index kind of thing. And so the challenge and the thing that really, really is kind of a kick to the guts is that what the builders are slowing building is the entry level market. So anything priced where first-time buyers and that kind of stuff, that's what they're slowing down. And that's the one that we need the most of, right?
Absolutely.
So, I am a little bit frustrated to see that. And so,
they're gonna feel the ding on the homes that are $400,000 or more right now, just because they're not gonna move those. And honestly, I'm seeing some builder incentive to the agents now versus.
Suddenly builders love us again. Yeah,
and also to
not playing
the
with
buyer.
our commissions no more. Yeah. Sorry.
Be nice.
So, but this, these are the numbers from Fannie Mae, and you can see what has happened with these are single family new construction starts, and you can see how it's trended down for the last 5 months. So they're building less than they were. Now, when people say, why are we have a shortage of housing? Look at what's happened since 2008. If you look at 2008, there's this massive trough in there. And so we haven't built enough homes for a long time.
Well, for 12 years.
Yeah. And now we got the largest home buying segment, the millennials, over the next 4 years, all reaching first-time home buyer age. Yes, I know interest rates are going on. Yes, I know the markets are crazy, but just simple versus supply versus demand is still a big deal for us here.
Absolutely.
All right. IRS increases their mileage rate.
Yay.
So for those of you that use Mile IQ like we do, or that kind of stuff, it's good that, it went up from 58.5 to 62.5 cents kind of thing. So just wanted you to kind of know what's going on out there, because goodness knows we need all the help we can get. So in training this week, so tomorrow we have Blueprints New Construction Buyers Agency. That's in person in our Fayetteville office. On Wednesday,
to join us.
Yes, Wednesday, Mortgage 101 is in person in our Conyers office. That's at 9:30. At the same time, my lovely bride is going to be teaching
GAR versus RE form. So please take a look as the form has changed.
And look, there's all kinds of little nuances between these two different forms in there. What's included here, what isn't here, that kind of stuff. And so I don't care if you're a realtor or a real estate professional. If you're a real estate professional, you need to know what's in the GAR forms. And if you're a realtor, you know we're going to get offers in on both of them. And then Thursday, my bride again
teaching code ethics in West Georgia. So for those of you who are out in Douglas and Carroll County, please come see me. Love to see you.
Yep. So I hope you guys have a great week. Again, happy Juneteenth. If we can be of any kind of service, please call, text, smoke signals.
I hope you all had a great Father's Day weekend.
Yeah,
have a great Monday. Take care.